Welcome, everybody.
Hello, good
We're
morning.
so glad you could join us.
We are. This is good.
This is awesome. Welcome. It's Saturday morning. We just want to make sure we're doing a sound check. Can everybody hear us?
I hope so.
If we have our team out there, please send me a text that you can hear. We tried a little bit of a different setup this
We're
morning.
getting fancy.
And we're getting
Aren't we
fancy.
getting fancy?
Yeah,
We're getting a little fancy.
We're trying to create a studio. So, guys on our team, if you can hear me, send me a text that the sound is working.
Heather just said yes.
Oh, great.
Thank you, Heather.
Okay.
Yeah.
So welcome to Strategies for Wealth Management.
And Rock Your Retirement.
I am Michael.
And I am Laura.
And we are from Strategies for Wealth Management. I'm President CEO.
I guess I'm Vice President. I don't know what I am.
The bottom line is, this is our company.
Yeah.
And we have an amazing team.
We
have
do.
An amazing event for you this morning. So glad you could join us. Here's a story about this. So last week, we did this live. Last week, right? We did this. Hold on. I'm going to check something.
Yeah. By the way, did you want to talk about like the little buttons on the side, or are you going to get into that?
I'll get into that.
Sorry.
People are still coming on. And
okay.
I'm seeing,
All right.
we got a lot of people coming on.
All right.
And so last week, we did this event live in Trumbull, Connecticut at the Trumbull Marriott.
Yes.
Now, we had a lot of people there, right? It was a continental breakfast.
Nice.
We had a lot of people there. But we had so many other people saying, I wish I could come. I had plans, or I wish I could come. It was a little too far, because we have clients all over the United States.
Yeah.
But like if you're in Massachusetts, you're probably not coming to Trumbull.
Plus, also, we did it at 9 o'clock. Maybe next time we're going to do it a little later.
Yeah.
But that might have been a problem too.
And then also, we have people all over the place, right, who said, I would love to get this information, but I just can't come.
Yeah.
She said, why not do a live webinar to reach everyone? And this is what we're doing, an encore presentation of the Rock Your Retirement workshop, right? But we're doing it live. So we're so glad you could join us. And a few little items here. If you're new to webinars, COVID changed everything, right? So we do a lot of stuff virtual.
Yeah, and it's actually really nice because you're all home, hopefully in some air conditioned, or you're swimming in a pool that you opened extra early this year.
Yeah.
But yeah, make sure that you start in the chat. We've got this great feature on the webinar. We can't see you, only you can see us. So you don't have to worry about that.
Right,
if you're in your pajamas, it's all good. But there are 3 little dots off to the right-hand side if you're on a computer. And if you're on your mobile device, it's usually below us.
Correct.
And you want to open it.
Yeah, look for those 3 little dots now. And you want to open that.
Yeah, it's a tab.
Now, I will tell you that as much as we can't see you, we want to interact with you.
As much as
and
you
can.
can.
There's a few things we can do to interact with you. For one is we have a chat. And a chat is your way to ask any questions or any comments that you might have, right? You can chat where people, you could do private chat?
Yeah, you can turn on the chat to be just us are going to see it, or you can do for everybody. Oh, look, I see everybody.
We see
hi, everybody.
Cheryl,
hey, Debbie.
Hey, guys.
Oh, it's good to see you. So that's great.
John's
you guys,
on here.
They all found the chat, which is awesome.
Okay.
Because also, in addition to the chat, Michael and I are going to be polling everybody at a point in the workshop. And you need to have the chat open because the poll opens up on there.
When we do a live event, I can ask the audience. Yeah. Raise your hand. Say yes. Right?
Yeah.
Here I can't hear you. So one of the things we added to this is a poll, and we're going to ask some what we call polling questions as we go on. So it's really important that you find this chat. And the last thing is we have some special offers for you guys. And that too.
Yeah.
I want you to make sure
you stick around so you can hear. We have
right now,
special.
well, not only the chat, but those 3 little buttons. So right now, definitely find those 3 little black dots to the right, to the bottom. Click on it. If you go to another page, it's not going to take you off this webinar. Make sure you're familiar with that, because that's going to be really important to today's virtual workshop.
Yeah.
In addition to that, make sure your volume's all the way up, take some notes, and we are going to get started.
Yeah.
All right?
Yeah.
So let me just say to you up front, let's just,
we got to put the slides up.
Right,
there we go. Now we shrunk.
Let me say to you up front, everything we cover today is conceptually based. What I mean by that, as fiduciaries, right, everything I can show you strategies. We can show you strategies, but I don't know if it's a good fit for you or not. We don't know if it's a good fit for you or not. My team doesn't know if it's a good fit for you or not. So what we show you, right, is concepts. But if anything we show you today you're interested in, we do need to talk with you. because proper planning is being able to understand your situation and see if it's what we call suitable.
You know what, I always like the analogy, like if you want to work out, we can talk about exercises in general, but then I used to be in the fitness industry for many, many years, and I can talk about this exercise or that exercise, but I had to create a program based on that individual's goal, their body type, their abilities, where they're coming from, what they come to me with. It's no different in the financial world.
Nope.
We're going to give general concepts. This is not going to be specific, but it's important to know the concept, to know if this is something that you want to do, you want to move forward with, in your future.
And I guarantee you're going to hear something today. You're going to go, I didn't know. There's a saying, you don't know what you don't know. You will hear something today that you say, I didn't know that. And you need to take action to set up a time with us to talk, because if you don't know it and it sounds interesting, and I guarantee out of everything we go over, you're going to hear one or two things. You're going to be like, oh, this sounds interesting. And let's see if it's a good fit. Right?
Exactly.
We don't know if it is or not. Pretty neat camera. It autofocuses. I'm waiting for it to autofocus. Hello. All right. I'm hoping it'll autofocus, but let me get back to the slides here.
All right.
There's a little trick if it does.
Oh, yeah, you do your white. Okay.
We're good though.
Yeah.
So we thought we'd first start with telling you our story. I think this is really important. We speak to a lot of people from radio, from TV, and they go, I don't really know Michael and Laura, right? So look, me personally, I've been in this business over 30 years, right? Laura joined, we've been married 31 years, going on 32 now.
I'm starting to lose track.
Yeah.
So 31.
she was right by my side when I started in this business.
Just a young lad you were.
Yeah, we were both just young.
We were young. Yeah.
But anyway, she's been right by my side.
Yeah, I came into this like 5 years ago, maybe a little more at this point. Yeah. And our littlest one, who is now 23, left for college, and I found myself with some extra time. And I love this. I love working with my husband. I know some people find that crazy, but it does work well. And so we've combined of 35 years experience.
So I want you to understand, you can't find a lot of people in the business longer than I have been. I am the best at what I do. Look, literally, if you're looking for good quality, after 30 years of doing this, you see patterns, you see people.
Yeah.
That's experience, my friends.
Yeah.
But here's what changed our lives. Personally, this is what changed the direction of our business and our lives, really. Mm-hmm. And that was this time period right there. Remember that?
Yeah.
So now, two things. One is we had money in the market. Mm-hmm. We had some of our personal money. Laura inherited some money from her grandmother. Mm-hmm. And we're watching this money. And we did what everyone told us to do, right? I'm in the business. I have an investment license, insurance license.
And we were relatively young.
And they're like, you put it in a diversified portfolio, you put it in the market, and blah, 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 blah. And then, market's crashing, and we see our money going down. And I will tell you, we got burnt by the market.
Yeah, that was really painful.
It sucked.
Because we were young. We had 3 kids, and whatever. It was like everybody else. It was a very big shock.
It really sucked, right? So here's the thing, we were calm. Yeah. We knew we could make the money back. We were in our 40s at the time. But the fact is, what I saw was I had clients I was helping with all kinds of things, insurance, Medicare, long-term care, life, and these clients were devastated. They were in their mostly 60s and 70s, some in their 50s. They lost half their money. Yeah. And they go, what do I do now? And they were calling me for help. Yeah. And what I saw is I realized, guys, there's got to be a better way. There's got to be a better way to do financial planning instead of treating everyone the same, like they're 30 years old and they could take risk. Sure. And I'm telling you, to this day right now, I'm seeing that with a lot of people. Yeah. They don't realize it when the market's going up, but when the market's crashing like we're seeing right now, their eyes open wide because the brokers are treating your money like you're 30 years old.
Well, I feel like just like many other industries, it's like old school.
Yeah.
It's like they're doing the old way, with everybody. And actually things have changed. The world has changed, as we all know, and you have to be able to flow and bend and go with it. So, yeah.
Right. So we learned a big lesson, but what I got to tell you, I was so, I felt so bad for people who spent their lives building up their 401ks. They were going to retire in a few years, and all their plans went to crap because of that, beyond their control. And I said, there's got to be a better way. So I started looking at this a little differently, and I started saying, look, the best way to do this, particularly if you're 50 and over, and you're in a stage of life where you're kind of within 10 years to 15 years of using your money in retirement, I was like, we got to start wipe this slate clean,
Yeah.
right? And start like we're building a house. Most important part to the house, a foundation.
Mm-hmm.
And what we want is a really strong financial foundation. One that when a financial storm comes in, like we're facing right now,
Yep.
it's not going to be washed away because your foundation is built on sand, which is what a lot of people are finding, right?
Yeah.
So we wanted something where a portion of our money is strong, safe, risk. I mean, I was kind of like Teflon, like
Avoiding risk.
risk,
Yeah.
like get gains, but don't worry about the downside.
And I have to say, during the crazy times that we're now experiencing, our current clients
Yeah.
are feeling the benefit of having a strong financial. Because part of what we do is we start there, right? We always start there.
We want to start with a strong foundation, and then on top, it's like building a house.
Yeah, no different.
Build a foundation on rock solid, right?
Yeah.
And then build the first floor and the second floor, the kitchen and the family room. That's a level of risk, right?
And by doing the foundation, by building
Right.
your strong foundation, you get rid of the panic.
Yep.
You get rid of the freaking out because
Yeah.
you know, hey, look, I got the most of my stuff in a place where it's not exposed to this.
Exactly.
And then I know that this that is exposed, I signed up for it,
Right.
and I know what it, you know what I know what I'm in
And then
for.
you can decide how build you want to, how tall you want to build
How
a
tall you wanna build it.
skyscraper. Like if you want a first floor or second floor
Up to
house,
you.
like you're taking a little
Everyone's
risk, that's great.
different. Yeah.
If you want to build a 50 level house because you want big risk, that's okay, but build a foundation.
Yeah.
Nothing works without a strong foundation.
So
And that's
true.
really what changed
So
our
true.
planning and changed our life. And we talk about it in our book. We have a new book out called Rock Your Retirement, a guide to building a financial strong retirement plan. And we talk about that. We have a surprise for everybody. You want to tell them?
Yeah, I mean, because you're on the webinar today, Michael and I, are we mailing them? We're going to mail them?
We'll mail them.
We'll mail them. We're going to mail you all our beautiful book.
Right.
Which I'm very proud of. So
we're going to tell you how to get the book.
We'll tell you at the end, but we're going to mail it to you. So you hang in there because we are going to send it to you.
If you'd like a copy of the book, we'll send you a copy.
Look,
of
it's
the
an
book.
easy read.
Yeah.
We keep it easy to understand, but full of really good stuff. And again, it's complimentary to this webinar today.
And a lot of what we talk about in this webinar in the book as well.
Yeah.
In addition, we talk a lot about what we talk about the book in our Rock Your Retirement TV show, which we're on many different local stations here in Connecticut and been on nationally, Fox Business, Bloomberg, and Travel Station from time to time.
Mm-hmm.
But every week we're on these local stations. So we got some people watching us from the TV show.
Yes. Oh, yeah. Some people from
watching,
TV are
on. And we got
on.
some people watching us from the radio show.
Michael's on
we have
radio.
Safe Money Income Radio.
Hello, radio people. This is what he looks like.
little secret, if you listen to the radio show, like, okay, it's 10 o'clock right now. How could I be doing a webinar on radio at the same time? The radio is pre-recorded.
Yeah.
It's not live.
Yeah.
I couldn't do all those stations live, but it's a great radio show called Safe Money and Income Radio. It's how to build a strong foundation too.
Yeah.
You know, and then we also have a little what we call behind the scenes. What do you call it? Like a podcast or a video podcast.
A vlog, a podcast. It's like 10 minutes. 10-minute segments that Michael and I recorded when we were out in Las Vegas recently. We had the opportunity to do this in a beautiful studio.
Oh, yeah. Amazing.
And we wanted to talk a little bit more about financial stuff, but a little bit more personal because people are like, who are you two?
Yeah, like
who are you really?
Comments like, here's the thing. This is a virtual world now. But COVID 2 years ago, before we had 6 offices.
Yeah. My gosh.
I'm doing live seminars in different restaurants 2 times a week. It was exhausting, right?
Yeah.
COVID hit. We said, this is ridiculous. We can't do it in the restaurants anymore. And quite frankly, we kind of switched to virtual. We do a little combination of both now. But if you're watching, look, this is the world, virtual, right? Like to us, do you want a great planner or a planner who lives down the block, right?
Yeah.
We could do so many things for our clients, and we could reach so many more people.
Yeah, it's definitely more effective. It's more efficient.
But one of the challenges we have is people don't know us, right?
Yeah.
And it's like, get to know us. Well, one of the ways to get to know us is watch this YouTube video. It's on YouTube. It's on our website. It's called Michael Laura Behind the Scenes.
And if you want in the chat, you can just say, please send me the link, and we'll go ahead and send you the link.
We talk about our experiences growing up, our relationship to money. We also bring up things for you guys to think about.
Yeah. So anyway.
It's a great little alternative. I can tell you people who've watched it love it.
They
so
do.
watch it. Now, and we also do live seminars still. Look, we've educated thousands of people on strategies we're going to talk about today. today. But keep in mind as we go over it, Laura and I are not in the prediction business. We're not going to give you, the prediction of what might happen. Who knows, right?
Yeah, we don't know.
We're in the protection business. We're like cover your bases either way. Things happen good, great, take advantage. Things happen bad, be covered for it either way. Does that make sense? Hopefully put in the chat, yeah.
Put in the chat, yes, but it makes sense to me, and I guess that's why I stuck around for 32 years.
That's why we're married.
Yeah.
And a little bit else behind the scenes. Look, we have 3 wonderful children and 1 grandchild. And so,
and we're going to see her this coming weekend.
So we're going to see our little grandchild.
And we post pictures of her for shameless when it comes.
A few things. You're going to hear some things throughout this webinar. Also the book, right? If you want a copy of the book, if you hear something throughout the webinar that you really like, do me a favor. We are going to offer everybody on this webinar, this virtual workshop, a complimentary consultation. Now, it's up to you to tell me, based on what you hear, what you would like to talk about, because we're going to cover a few different things. But in order to do this, I'm going to put this up right now. So if you hear something that you're interested in, you need to click this. I'm going to put it up right now. Publish, okay. So on those 3 little dots I talked about, now you have a chat, now you have a second thing. And the second thing is called a complimentary consultation. And you could click on that, you fill out a few things, and my team, it's Saturday, so my team on Monday will get back to you and we'll schedule a time to talk.
Yeah.
Sound good?
Yeah.
Right? So as we move on, and it's complimentary, so as we move on, let's quickly set the stage and talk about this young man.
I love this story. I never get sick of hearing it. I just think it's a great story.
Exactly. So this person's name is Cliff Young. And some of you have been to our events, you might have heard it, but this has everything to do with what we're going to go over today. Now, Cliff Young, 60-year-old at this point, was taken in the 1980s. He lived in Australia. He was a farmer, a sheep herder, and a potato farmer, too.
Yeah.
So he grew potatoes and herded sheep. He had no money, but he decided to enter a marathon. Not just any marathon, guys, 544-mile marathon across Australia. 544 miles.
Yeah, so right off the bat, you got to think this guy knew something we all didn't know, because he's 60 years old and he's going to enter a marathon. He's got something up his sleeve.
Now, here's the thing.
Yeah.
Everybody else, this marathon takes 5 to 7 days to complete.
Right.
It is very hard. It is not like, and the other people entering it, most of them were a lot younger than Cliff, and they had trainers and sponsors.
That's what I mean, yeah.
So, and here's the important thing. It's called the Cliff Young story. It's a great story. Highly recommend you learn about it.
There's actually not a ton on the internet about it. No, there's not. And we always say it should be a movie.
It should.
But anyway.
In any case, here's the thing about Cliff, right? He enters this race. Now, everybody else in the race, these athletes, they were given by their coaches, everybody gave the same advice. Kind of like what goes on today. You watch TV with these fancy.
One size fit all.
One size you're fit in all. The market, right?
Yeah.
One size fits all. You're in it for the long run. Everybody have mutual fund.
We're all the same.
No.
Yeah.
So Cliff said, so the strategy to win the race was run 18 hours a day and sleep for 6. And that's what everybody was told to do. That's what you do. You don't even question it, right? And Cliff came along and said, I'm not doing that. I have a different strategy. Now, I'm going to finish the race. I don't know if I'm going to win it, but I'm going to have a different strategy. And my strategy is I'm just going to keep running for 5 days straight. I'm not going to stop unless I got to go to the bathroom or eat some food, but I'm going to keep running. And everybody thought he was crazy. They laughed at him. Actually, the doctors almost prohibited him from running the race because they thought he would die doing it.
Oh, my gosh.
And he goes, you know what? No, this is my gut is telling me this is what I need to do.
You know what? You said something really profound, though, a few moments ago. You said.
I did?
Yeah, you did.
I always say profound.
He said, I may not win, but I'm going to finish.
I may not win, but I'm going to finish.
That's a very big thing to think about there, right? You don't have to be the best. You don't have to have the most. I just want to do it and finish it. Because in his mind, that was winning. Like just knowing I can get to the end.
It has everything to do with retirement planning.
No, I know. That's why I brought that up.
Retirement planning is not a sprint; it's a marathon.
Yeah,
so follow me on this. The race starts day 1. Cliff's in last place. Everybody else runs for 18 hours. They go to bed. 6 hours later, they wake up. Guess who's in first place?
I know.
Cliff.
Crazy.
Not by a lot, by a little.
Yeah.
So they spend the first few hours of the day catching up to Cliff. Right? They had to play catch up. And then they surpass Cliff. They run for their 18 hours. They go to bed. The next day they wake up. Cliff's got a bigger lead, and they had to spend more time catching up to Cliff. By the third day, Cliff had such a big lead that they couldn't even catch up to the guy, and Cliff won the race in 5 days. 5 days.
Yeah.
Here's the amazing thing, though.
Yeah.
The second place person finished 10 hours later.
Yeah.
What does that tell you?
Yeah, it tells it says that not having to make up for lost time will set you ahead. Here's the interesting thing. You mentioned he was a farmer.
Yeah.
So what do farmers do? They get up with the sun.
Yeah.
They get up really early. They walk around large areas of field. They're outside all the time. They're used to elements, right? So when I said I think Cliff knew something no one else knew, he had that experience under his belt. He knew what he was in for, right?
Exactly.
And he saw it ahead of him. He had the foresight to know there's going to be hurdles along the way, and I know I'm used to that, right? And that's just like planning, no different.
So look, if you're risk adverse, don't let people talk you into taking risks.
Exactly.
I mean, there are other ways to grow your money. We're going to show you a great way to do it.
Yeah.
But the point is, retirement is not a sprint; it is a marathon, right?
It is.
Now, Cliff knew he won the race because he won the finish line.
Right.
But in retirement, how do you know that you win the race? How do you know?
Well,
well, we know because we get responses from live audiences.
Yeah, like when
the correct answer is right. You have more money left at the end of your life than more life left at the end of your money.
And sometimes it takes a minute to sink in, honey. So let everybody think about that.
More money left at the end of your life.
Right.
Than more life left at the end of your money.
So you didn't outlive your money.
Well, you win the race if you
don't outlive your money.
And I got to tell you, 30 years, I've seen some people win the race.
Yeah.
I've seen some people run out of money.
What's the difference?
Planning.
Always.
So the difference.
So don't panic, plan. That's my thing. Don't panic, plan.
We don't have to get first place. We have to finish.
That's right. We got to.
But here's the problem: planning, because what's going to happen? Obstacles are going to get in the way.
Absolutely.
Look, in the marathon, we can talk about running a 544-mile marathon. We're sitting in our office here in Shelton, Connecticut. But the fact is that Cliff ran into a lot of obstacles. Anybody you hear anywhere on any of these Ironman marathons, there's obstacles in the way that you can't predict. Yeah. So you got to plan, right? You got to hope for the best, plan for the worst.
And I think what we're going through right now in our current financial situation is a hurdle. This is a hurdle, and the people that have planned are not panicking.
Correct.
They understand it's a hurdle. They're riding it out, and they also have a great foundation, and they know that if something, God forbid, happens, they've got their foundation under them, and they're going to be strong. Yeah.
Exactly. Hey, we got a testimony on the book. I already have the book. It's great. No need to send me one. Thank you.
Thank you.
Appreciate that. Right. So with that said, getting back to the slides, look, if you take one thing from today's workshop, and I'd say we're calling this a workshop. This is not just a quick little webinar we're doing. We really put a lot of effort into this. So we want to give you the information. That's the whole idea of this, right?
Yeah.
So we take one thing today, it's plan. Planning is so important.
Yeah.
Have a plan, right?
Have a plan.
So look, we talk about obstacles in a race.
You're going to write this down, guys. Write this down if you haven't already, if you don't know. These are important.
5 major obstacles when you deal with a successful, rock-solid retirement. Mm-hmm. And we're going to go over these 5 obstacles, the 5 major ones. There are some minor ones too, right? Yeah. But you're running the race, you hit a roadblock. What it could be. What can take you off your game? If you're running a race and you trip and fall and hurt yourself, you're out of the game, right?
Yeah.
These are obstacles that can take you out of the game. We want to make sure that we're prepared and we cover them as best we can. It's not about winning, it's about finishing. Hope I made that clear. Thank you for that distinction.
Yeah, that was really good.
I just came up with that this morning.
I don't know, honey. Every day you shock and surprise me.
I could use another cup of coffee, but so to go over them, look, real quick. We're going to talk about inflation, unexpected healthcare costs, taxes, income, and investment risk.
Yeah.
But what I want to tell you is they're all connected. It's like throwing a rock in a lake. It creates a ripple effect. One is connected to the other is connected to the other.
Yeah, I mean, it's like any other thing in your life, right?
I'll tell you a quick story. And this is, connecting a few of them.
Yeah.
Shortly after 2008 crash,
I
had a woman come into the office crying. She's like, do you do reverse mortgages? Now, reverse mortgage is a way to tap into your equity of your house. I don't do those, but I asked her, I figured there's some money issues. What's going on? Yeah. And I couldn't help her, but I was shocked at her story. Before 2008, her and her husband, they had a portfolio of $3 million. Mm-hmm. I mean, that's a nice portfolio, right? Mm-hmm. Maybe you have more, maybe you have less. It's not the point here.
Right.
They had $3 million. Now, the husband, he thought he was smart enough to manage it himself. And he was picking his stocks. But honestly, at that time, before the crash, you could throw a dart at a dartboard and pick stocks and get gains. It wasn't that hard.
No, but it's also not about being smart.
Right.
You know what I mean? That's not what it's about.
So he thought he was a big shot picking his stocks and, all these stuff. And you know what? One critical mistake. And he lost half of his money. He got caught in 2008 market crash, and it's easy to do because the market goes down. You go, I'm gonna wait till it comes back. It, comes back.
It's
you
a
get
trip.
A tease.
It's a head trip.
Oh, okay, we're on a roll, and then it goes down, and
right.
it doesn't just go straight down. It goes, boop, boop, boop,
Right.
And so 1.5 million, still a decent amount. Here's what happened though. He lost his job. Remember, people in an economy like that, housing crashed. People lost jobs. It's not one thing that'll screw you up. It's a bunch of things.
It's the ripple. It's the ripple. It's the ripple.
So he lost his job.
Yeah.
And they had to use that money to live on.
Yeah.
And then something really dramatic happened. He had a stroke.
That's like healthcare.
He wound up in a nursing home.
Yeah.
And all the money they had saved all their lives was wiped out between those things.
Yeah.
And now he was gone. The woman came in. She was Social Security age. And all she had to her name was Social Security income and the equity of her house. At least she had the equity of her house, right?
Yeah.
But imagine that. And that's why I say, guys, it's all connected.
And I think the important thing to take away from that story, because I'm so sorry that woman went through that,
terrible, right?
but I think that affected you profoundly.
Yeah.
And it's not going to happen to us. And all the things that messed them up were unexpected. And if you think about anything in your life, like your home and having homeowners insurance for the unexpected, it's all protected so that in case that happens to you, you've got your foundation or your protection. And that's what Michael and I are about.
We are brought up learning, and our parents teach us, protect catastrophic risk.
Yeah.
A house burning down, catastrophic. A car accident's catastrophic. A major health condition is catastrophic.
Yeah.
And we'll go over this, right?
Yeah.
Losing money in the market, a large amount is catastrophic. Guys, they're a way to insure these things, right? They're a way to protect yourself.
Yes.
Again, it's not about winning the race, it's about finishing the race.
Exactly.
So we're gonna do a little exercise today. It's called the financial wheel of life.
Yep.
Now, in a perfect world, you'd be in front of me, I'd hand you this worksheet. We can send you this worksheet. If you want the worksheet, just put it in the chat.
For it.
You want the worksheet.
It's in the book.
It's actually in the book too.
Yeah.
And we can get you the worksheet. But today, just play along with us. Pretend you have it, right? Because we're going to rate each category where you guys are prepared for each one of these categories. Mm-hmm. And we're going to start with inflation and then healthcare costs, taxes, income, and investment risk. And then you see it's kind of all connected, right? So let's talk about inflation real quick. Now, again, I'm going to keep things basic. If you want to talk more, you got to set up an appointment with us. If you're new, if you joined us a little late, look for those 3 black dots on your right-hand side.
That's on the side or on the bottom.
3 black dots. Tab on the right or the bottom. You want to click that. You're going to be taken to a chat. You're going to be also taken, like you'll have a screen. You could go on our chat and ask us questions
and
or
say
comments.
Hello, ask us questions.
You can also, we put in how to set up a complimentary consultation. Just click on that link and you won't leave the webinar, I promise. There's no secret right now. Inflation, I mean, if we were talking a year ago, 2 years ago, very different, but inflation is all-time highs. It's unbelievable. I did an Instagram live this morning. Did you see it?
I liked it.
Okay.
I was getting ready.
We're using social media as much as we can, but I was filling up my...
I thought you were filling up the gas.
Why did I buy an SUV? I'll never know, right?
Well, no, I know. It was a good idea.
The time was good. I was carrying a lot of stuff with me because we do live events.
Yeah.
Right, but I'm filling up the car. I get to gas station.
I can't.
Do you guys know it was for premium because, of course, I want to treat the car well. I own it, right?
Yeah.
Over $5 a gallon.
That hurt.
Right? Over $5 a gallon.
So, yeah, that's crazy.
And I'm like, when is this going to end? So, guys, inflation is rearing its ugly.
My gas is getting lower, and so I'm now looking at the gas tank on the way here this morning, and I was thinking, I should probably get it today before the prices go up again tomorrow. Like, that's what it is. It's like, you got to hurry up and get it because I feel like the price just keeps going up every day. Diesel is at record highs.
I just heard on the news
crazy.
A lot of gas stations are resetting their things for $10 a gallon.
I can't.
Do they know something we don't know?
See, that's why we're virtual, everybody. Yeah. I mean, you can always come visit us.
Right? So here's 3 strategies. Again, if you want to talk about this, you set up an appointment, right? Yeah. But one strategy is, look, earn higher fixed interest. What does that mean? If you've got money sitting in the bank, wasting away because you're losing money in the bank, you're getting more dust than interest. Mm-hmm. Here's the shame of it. Inflation and interest rates have gone up. Have banks raised stuff? No. Banks are greedy. They keep the money. I'm sorry. I'm like on a roll today. But look,
Ooh.
How could the banks not give us more when interest rates are going up? It's ridiculous. What do banks do? Banks are a business. They take our money, they loan our money out. They're making more on loaning our money now, and they're not even returning it back to the consumers. I'm not a fan, but we have to keep some money in the bank.
You have to keep money in the bank. It's part of the whole thing. But you know what? The money in the bank is called lazy money. It's really not even doing, or dead money. I mean, if you really want to get into it. So yeah, go ahead, honey.
So if you have emergency money, keep in the bank. When they pay your bills, keep in the bank.
You have to.
Any other money you got, you don't need short term. I'm going to tell you, we can show you an easy strategy to keep it as safe as a bank and get you 2, 3, 4, 5 times the amount of interest a bank, easy, and keep it as safe as a bank.
So a lot of people have sold their homes. They've got and like Michael and I just sold our home, which was a very big event for us. And the money sitting in the bank, let me tell you something, it's not working for you in the bank. It's lazy or dead.
So just set up a complimentary consultation and we will show you that. Just tell us your situation. Now, another way to do it is, look, have an increasing income plan. What do I mean by that? Have a rock solid income plan, but if inflation is going up and your income is staying the same, that's a problem. Now, some of you are working and we need to plan for income. Some of you are retired, and maybe we need to adjust or look at your income plan, right? And the last one is avoid major market losses. And what I mean by this is a double whammy. This is really what's catastrophic about this. When inflation and interest rates are high and you lose 20, 30, 40% in the market, you create such a big spread, it would take you so long to get that money back because you lost. I mean, if inflation is low and you lose money, it's bad. Right? But if inflation is high and you lose money, it's catastrophic.
It stings that much more, right?
Look, guys, I hate to say it. The market's down. We all know it. We're feeling the pain. This is nothing compared to what it could be. You know, it's buy low, sell high. The market, if you look at it a year ago, it's down. But if you look at 2 or 5 years, it's still up. If you're in a casino, take the money off the table.
That's right.
I am telling you. You get a ding, you lose 10%.
I want to shout out.
The world.
Barbara asked for the book. Barbara, you get the book. Hi, Ron and Millie. I'm so glad you guys are here. Welcome.
Anyways, I can't stress this enough. Have a plan to cover your downside. Look, if you lose 10%, not the end of the world. But when you start going down 20, 30, 40%, it is catastrophic, especially when inflation is raising it.
But if you have a foundation, a strong foundation, and that's happening, you're not panicking.
So here's what I want you to do. Where it says inflation, you're going to see an arrow. Actually, I'm sorry, we're going to do something different.
Yeah, we have a poll, honey.
So I thought we were live. So I'm going to put up this poll. Where's inflation?
Oh, sorry, I didn't do it in any particular order. Hang on, guys. We got to pull up the inflation one.
So I'm going to put up this poll here. You need to find that tab with the 3 black dots on the right or on the bottom, and you click on it. And when you see poll, you're going to see some options here. Now, starting from a scale of 1 to 10, 10 being you are covered for inflation, you got this. You know exactly what inflation is doing, and you are okay. 1 is, hey, you didn't even know about inflation going on, right?
Ah, look at we got some results.
I want everyone to vote. I want to write down these things.
Yeah.
I'll go grab it. You keep them company.
I'm keeping them company. Thanks, honey. So here's the thing. In addition to inflation, you all might have heard of something called stagflation, which is where the economy is just stagnant. And then there's another thing. It's sizeflation. I think it's called, where the sizes of things are shrinking, but you're paying the same price. What's that called? Not size. Is it sizeflation? Where like a pint of ice cream has shrunk. It's not really.
And all of a sudden math has changed and the pint is 10 ounces.
They're getting us that way too, so we don't notice it as much.
So what we're doing is at the end, you'll see how this is all connected. I want to pretend everyone's live, but we're rating ourselves in inflation.
Well, we are live. You mean in person?
In person, I'm sorry. But look, the majority of people are like 5 to 6. Would you say right now?
Yeah, it needs some tweaking, but we got a couple. We got some people who plan. So look, this is not a judge. And by the way, we don't see what your answers are. It's all anonymous. No. So when you're putting poll, we just see numbers. We don't see names. So don't feel embarrassed.
42% answered 5 to 6, 28% 3 to 4, 28% 1 to 2.
Here's the thing: nobody has got this or pretty decent. So we
can help you with this, guys. If we can't, we'll tell you we can up front.
Yeah,
we
absolutely.
might be able to help you with that. but I'm going to consider this 5 to 6.
Most
right?
people. Okay, that's
okay.
fair. Fair
so
enough.
I'm going to end this poll. We're going to do another one.
We're going to talk about the next subject, and we'll do
awesome.
another.
I love this, right?
You do?
Yeah.
Okay.
Really
yeah, that's
awesome.
fun. It's fun to see
so
everybody.
Go back to slides.
All right.
So that's called the financial why. Imagine you had that wheel and you've circled 5 or 6, whatever you circled.
Yeah.
But if you'd like help with this, don't delay. First come, first serve. We have a very busy schedule. Talk to me, talk to my team, and we can show you options to have higher guaranteed fixed rates and keep it a savings.
I have to say something about what you said, talk to you or your team. I just want to mention about our team because our team is fantastic. And I got a call yesterday from a gentleman who thought he was a client, but he's not a client.
He found us on Google. He thought he was a client.
And I'm like, sir, who are you trying to call? He said, I'm trying to call Ameriprise. I said, you've reached Strategies for Wealth Management. And he just went on about how he can't get them on the phone and there's nobody to talk to. And I said to him, look, if you want good service, you got to go with what we are is the intermediaries between the carrier and the people, right? We're the people who help. We don't keep people on hold. We do the holding for you guys. And that's our job. And we have an amazing team who they never complain. You guys, current clients know this. I mean, Heather and Melissa, and then we've got Doug and John and Sharon. I mean, everybody does an amazing job, and we are lucky. We are just so lucky.
We may not be perfect, right? I mean, we may not be perfect.
No one's perfect.
But I will tell you, you get a call from someone who's with another company, one of these big box financial firms. They try to get someone on the phone.
Oh my gosh.
It's an over an
Heather
hour.
has nightmare stories.
It's an over an hour wait.
Yeah.
This is absurd. If you are paying fees in an account and you are having someone where you've got to wait over an hour to talk to them, how dare them? And quite frankly, you may want to think, why would you have their money with them? How can you trust them if you can't even get them on the phone?
Well, it's upsetting because time is really the most valuable thing. So that's crazy.
My biggest pet peeve.
Yeah, no, it's
you won't get that with us.
So
I promise you, we won't let you down.
I just wanted to mention that because we do have, and I think our team is.
I promise you, we do strive to give the best customer.
We do.
Look, we're not a big box firm. We could pick and choose who we want to work with. We don't have, you go to Fidelity, they got to work with everybody. You know, we can pick and choose it. We want good quality clients because we treat our clients well.
Yeah.
And we give them the best customer service.
All right.
All right. Sorry, I got on a see what you made me do.
I'm sorry. I just had a shout out to our team.
So let's go unexpected healthcare costs.
You touched on this a little bit with that story.
I did. Look. Yeah. Understand I'm going to go over this quick. You got Medicare. Medicare is something you get when you're 65 or older. Okay.
Yeah.
65 or older, you get Medicare. The problem is Medicare doesn't cover everything. It covers most things pretty well, but there's always co-payments and deductibles in Medicare. So people pick up a small policy called a Medicare supplement, and exactly what it's called, it supplements your Medicare, right? So between those two, from a healthcare point of view, doctors, hospitals, and prescriptions, okay, it's decent coverage, no problem.
Yeah.
The big gap we find for people is the unexpected healthcare cost of long-term care. Now, some people know long-term care because they dealt with family members who needed nursing home, assisted living, or home care. Other people have no clue about it until they get a surprise, right?
Yeah.
Look, you want to handle things before they become crisis. If you have a problem, fix the problem before it's a crisis. Because once it's a crisis, you can't fix it.
Yeah.
That woman and man who had $3 million, they had a problem. If they would have fixed the problem before it was a crisis, they would have been able to help.
They would have been in a much different situation, and that's why we're here.
So, real quick, long-term care is called custodial care. 1 in 2 Americans turning 65 will require some care in their lifetime. Doesn't mean, it could be from accidents, could be from illness, but custodial care is help with day-to-day activities living, help with eating, dressing, walking, that kind of thing, right? It's not covered under Medicare. It's not covered under health insurance. The options have gotten few and far between. The 3 most popular options right now, besides using your own money, and nursing homes here in Connecticut are well over $100,000 a year.
Yeah. I mean, the whole country is a fortune.
Traditional long-term care is an option. It's far and few between. It used to be years ago. People bought it. It's very limited. One of the bigger options right now is what we call a life insurance policy that has long-term care combined.
Yeah.
A lot of the new life policies actually will cover long-term care. So we're seeing, we'll call it a hybrid policy that, you want it for life, you want it for long-term care, great. If you die, it's going to be left to your family. And if you have life insurance and you happen to need long-term care, you can use it.
And what's nice is when you have old life insurance policies that you don't really need the death benefit or the life insurance part of it anymore. You really want to use it for other things. You can repurpose the cash value.
Exactly.
and use it for long-term care. A lot of people
Yeah.
don't realize you can repurpose your old life insurance policies if you don't need them anymore.
If you have an old life insurance policy, it might be time for an upgrade. Just like I've got this iPhone and it constantly says,
by the way,
can
I get my new iPhone today?
Go ahead.
I really feel like it's time.
I hate going to the store to do it.
It is
but
painful.
You can go do it.
It's very painful.
And then, look, that you have to be healthy to get. So if health
Yeah.
is an issue, there's some annuity policies that have some long-term care benefits.
That's a really interesting feature.
So again, it's important to understand that. And again, let's rate ourselves real quick on the poll of what we call unexpected healthcare costs. Let me find the poll.
I'm sorry.
How do I find the poll?
Go under polls.
I did.
Right there.
Reset
it.
All right.
Oh, well.
Okay.
Oh,
there we go. So let's do this. Let's
right there.
go under healthcare
there
planning.
You go.
I'm going to put it at that poll. Look for that poll real quick. And if you haven't seen it, please look for the tab with the black dots on your right or the bottom of the screen. And it's going to say, hey, as far as unexpected healthcare planning, are you fully covered? Hey, if you got a long-term care policy, Medicare supplement, or you're young, you're not 65 yet, but you have long-term care and health coverage, you're in pretty good shape,
you're good.
Right?
Yeah.
If you don't have any long-term care coverage at all, and you've never talked about it, then I say it's a 1 or a 2.
Yeah.
Most people are about a 3 to 4.
I'm so grateful. Michael started in the business, you guys, just so you know, doing long-term care exclusively for a very long time. And we were in our early 30s, so we have a traditional long-term care policy.
Yeah.
I am so thankful that we did that back then. And when I was 32, I was like, what is this? It was so far off in the distance.
So there's definitely, this one's mostly 3 to 4.
Yeah. Not very normal. We see this all the time.
I want to move on.
Yeah.
But here, I will tell you something. Laura mentioned about us having long-term care coverage. Mm-hmm. A little thing you may not know about me personally. It's just what I believe in, right? Because I've been in this business since I'm 25, right? 25,
I feel like you were 24.
24, 25.
Yeah.
But here's the thing, like I believe in business and sales, right? Mm-hmm. You should really own what you're advising people to have.
Oh,
in other words,
yeah.
If you're showing them something, you should really own what you're showing.
Yeah.
Now, with the exception of if I'm selling jet airplanes, I may not be able to buy a jet airplane, right?
I don't want
but
one,
to
so
the
that's all good.
extent,
Yeah.
Look, to the extent that you are giving advice to someone, to the extent that you can, you should own what you do. So everything we show you, I own. Laura owns. Our family has. This is like we walk our walk.
Yeah.
Well, I'll show you our accounts. Like everything we tell you today, we own ourselves.
For sure. And I'm so glad because I'm not panicking because I feel good about it. So, yeah.
So, all right. So we did that. Let me move on real quick.
Yep. Taxes.
Let's go over taxes.
Everyone's
this
favorite
is a big
subject.
one. I've got a little nugget for you on this one that you're going to love. If you haven't set up an appointment yet, after this one, you will click and set up an appointment, I guarantee you, because you're going to want to know more about this. But let me ask you a question. Do you think taxes are going higher or lower? I don't even need to see people because everybody says higher, right?
Right.
Look, understand there's only 2 purposes for money. If you really look at money, the goal of money is to grow. We all want to grow it. Nobody wants to lose it, right? But the purposes of money, and you know this, what's the first one?
The purpose is to use it while you're living.
Yeah. So, okay, I've got this money. We've got this money, and we want to use it while we're alive. Mm-hmm. We want to use it to live, maybe to buy something, experiences, travel. Yeah. Use it while we're living. That's why we work hard for it. Now, the other thing is leave it as a legacy. We have 3 kids. Do we want to leave some money to our kids?
Yeah, or there are causes we're passionate about, so maybe we want to leave some funds to that. Yeah.
If you really look at it, there's only 2 purposes for money, right? Now, like some people say, well, I'll use it while I'm living. If there's anything left, it'll be for the kids. It's okay. Nothing wrong with that. But if you purposely know money is there to use while you're living or money is there for a legacy, then you can actually make better tax planning decisions with that money, right?
Yeah, for sure.
So in my opinion, for taxes, because this goes deep, we got to really understand your situation, but you want to identify the goal of an account that you have. For example, if it's a 401k, if it's an IRA, it's probably more suitable to use for while you're living than leave as a legacy. If you leave it as a death to somebody besides your spouse, it's worth 60 cents on the dollar. They're going to get hit with a big tax crush because it was in tax deferred money, right? Sure. So that may be money better earmarked to live to take out slowly over time, right? But if you say, yeah, there's definitely money I want to leave as a legacy, there's money you can earmark, there's a lot we can do with it to leave it tax free, right? So the best tax strategy is based on the goal of the money.
Yeah, and that's easier said than done because I know a lot of people, I talk to a lot of clients who don't know the goal of the money. So,
our job is to help them.
Yeah,
right?
That's what we try to do, is help identify the goal of money, because that is really very helpful in especially tax planning, like you said.
Now, I do want to share one new strategy that's come up.
Yeah, this is interesting.
Here's the thing.
Write this down too, because it's a good thing.
It's an old strategy that was upgraded.
Yeah,
right?
Well, like everything.
Do you have a 7702 plan? Now, you probably say, what is a 7702 plan?
Yeah.
But it's called the 7702 tax-free retirement plan.
Mm-hmm.
Now, what is it? 7702 is a tax code by the federal government that considers cash value and life insurance a special tax treatment, right?
Mm-hmm.
Now, here's what you don't know. 2 years ago, they redid this tax code. You didn't hear it on the news. It wasn't sexy, right?
Right,
so
right, yeah.
You didn't hear it on the news. There's a lot of other crap going on.
There was so much going on in the world.
So here's the thing, if you know about this, here's what happened. They made it more attractive to build money in. They changed everything about the life insurance industry has changed now.
Yeah.
They made it a lot more attractive to grow money within a life policy. This is not term life and total cash value. Like, people always heard about whole life. Whole life is old school. It's like you're still,
using a brick cell phone.
Brick cell phone, right?
That we used to have.
Or you're still listening to music on a vinyl record.
Well, that's kind of cool now.
It's cool, but it's not effective. It's not the best sound in the world,
Probably
right?
not.
No, my point is the tax codes change everything. So if you have an old life insurance policy with cash value, you need to set up a review. If you're looking to grow money, I'm going to tell you right now, the 7702 tax-free retirement plan does this.
Yeah, this is important.
It's like a Swiss Army knife.
Yeah.
It cuts your taxes. It will help you pay for long-term care, unexpected health care costs. Mm-hmm. It will ensure your legacy if you want to leave money tax-free to your family, your kids. It will actually protect your money. There's no downside risk in the market.
Well, that's a nice
and
feature.
You will participate in the upside of the market.
Yeah.
This is a win-win.
Yeah.
Now, what's the downside? First of all, not everybody can have it. I gave it to you, now I'm taking it away.
Yeah.
Not everybody can have it.
Yeah.
You have to have some. You got to be pretty. You got to be healthy.
You have to be in decent health.
You don't have to be Superman.
And the other thing I want to say is the actual process of getting it. You have to really want it, guys, because this is not like an easy. It's not miserable, but it requires participation, and you have to really want it.
You gotta really want this.
We do so much for our clients. We help along the way. We do as much as we can, but there is a component to the 7702 where it does take a while to get the approval.
You need to want this.
When anything is
you don't have to be Superman or Superwoman. But you have to have some decent health.
Yeah.
And you also have to decide how much of your money do you want to make tax free.
Yeah.
Right? If you want to make $100,000 tax free, what we're going to do is do it over 5 years, right? We're going to do $20,000 a year for 5 years, and then 5 years later, now we have $100,000 tax free. We have a $200,000 death benefit for your family.
That's
that
nice.
$100,000 is growing without any risk of the downside of the market, and you have $200,000 to $250,000 to use for long-term care.
That's
right?
fantastic.
Like I just did a policy for someone $100,000 a year for 5 years. He says I want to make $500,000 tax free.
So takeaway from this is decent health, not perfect health, decent health. You got to have a willingness to want it, because it is about participation, and it does require some money to fund. You have to have some money.
If you have an old life insurance policy,
that's the nice
I don't know if it works or not, but you need to call us. You need to set this appointment up right away.
Yeah.
Like you need to set this up right away. Do not delay, because we can look at that and see if we can improve it.
Yeah.
I have one policy. I have an appointment with a client. He's going to flip when I show him the numbers.
He's going to be happy.
His death benefit's going to go up. His premium is going to be wiped away. And his money's going to grow better in the policy.
So,
if you don't have a 7702 plan and you're fairly healthy, you're missing the boat.
Yeah. It's a great thing. It's a thing. It's great. Talk to us about it.
So click that link, set up that appointment. Do not delay. This is really important. I think it's up there, right? Offers. Let me just double check. It is up there. Yeah. Okay, great. So don't delay. Do that. And let's do the poll right now. So when it comes to taxes, right? Are you familiar with the different taxable events in your portfolio? Are you tax plan heavy? Do you have most of your money in retirement accounts?
Yeah.
Do you have a tax bond waiting to go up?
Yeah. Do you have Roth IRA?
Do you not know? Let me put the poll up.
Yeah, put the poll up.
I'm talking, but
yeah, I mean, do you have a Roth IRA where you grow the account tax free and take it out tax free? Is it something you're thinking of converting an account?
The poll's open. The voting's open. Everybody vote.
You just nearly scared me. So there's some things to think about in the tax side of things, but take a moment, rate yourself, and then are you keeping track of everything?
I am keeping
Okay.
track of everything.
Yeah. What happens with the polls?
I just no, they're
Oh, there we
coming.
go.
All right,
Oh,
all right.
yeah.
So
Okay,
we're
good.
getting the poll numbers in. I feel like it's election night. I'm gonna win. All right. Woo, I'm gonna win.
Michael for president. You said you were president.
I am president.
Good. All right. So it looks like it's a moment we got people need some major improvement. Like this.
Yeah, like we got 3 to 4s,
Yeah.
5 to 6s.
It's anywhere between 3 and 4, but right now the 3 and 4s are winning. So
Yeah.
I say
Let's kind of call
50-50. Give it another minute. 3 and 4.
I'm gonna call 4.
Well, the bottom line is nobody's got this. This is
No.
a tough one. This is one of the tougher ones. So.
And look, you don't have to have the 7702 plan for you to
Oh,
get
no,
10
no,
here.
not at all.
But
There's other strategies.
if I find something new right now, I spend hours a week studying what's new. And Laura and I, we go to industry events all the
We
time.
just came back.
We actually learned this in an industry event. We were out in Las Vegas with 250 financial advisors across the United States.
Yeah.
And we did we spent half a day on this 7702 plan.
It's exciting
It blew
stuff.
my mind. I'm like,
Yeah, it's
oh my
exciting
God,
stuff.
this is amazing. Right?
Yeah.
So I'm gonna clear it as a 4 right now. And
Okay,
then
yeah,
we're gonna
call it.
move
It's
on.
a 4. It's a 4. Let's
Okay,
move on.
so let's move on to
Income.
income. Is there a time limit on this thing?
Yeah, but I think
What
we're
is
good. I think it's 2.
Oh,
we're not
we're
going to go
fine.
there.
No,
We're
no,
good.
no,
We're not. We're going to
good.
be done soon.
All right, income. So this is all connected, guys, right? But income is a jigsaw puzzle. What I can tell you about income, it is a jigsaw puzzle. And what I mean is it's changed throughout the years. Years ago, people retired, they had pension, Social Security, they had enough income coming in. Nowadays, I kind of see that pensions are far and few between. The income you need to supplement with 401ks. You need to supplement with some savings, right? There's questions. When do I take Social Security? When do I not? We could talk about that with you guys, right? But the most important thing I want to cover for income, because we have limited time here, is look, there's a thing called the retirement red zone. And the retirement red zone is 10 years before or 10 years after you retire. Why? Because income planning is one of the most difficult things you can do. Do not do it alone. Use an expert like us. This is one of the things we do, right?
Yeah.
We do it really, really well. I'm not going to sit here and tell you what hot stock to buy. I'm not a broker.
Yeah.
I'm not a broker who's going to tell you the stocks to buy, right? But when it comes to income planning, what I'm going to tell you is if you're in that retirement red zone, 10 years before, 10 years after retirement, income and assets and what you do on your risk level, they're both connected, can be either win the marathon, Cliff Young. Do you want to be Cliff Young?
Well, he didn't set out to, and he just wanted to complete it.
But do you want to be Cliff Young,
but
or
do you want to
not
complete
finish
it?
the race?
Yeah.
This right here will tell you whether you're going to finish the race or not. I guarantee it. Because here's what happens. Most people are in different phases of life financially, right? So the accumulation phase of life is when you're younger, meaning you have nothing and you're accumulating your money.
Yeah.
Our kids, 29, 27, 23, they're in accumulation mode. They're putting money away. The higher you get up the mountain, the more the responsibility is to keep your money, growing your money, keep accumulating it. But now you got to protect your money from going backwards.
And I think the preservation time in your life, people misunderstand it as, not growing. Absolutely not. You're still growing in preservation.
Absolutely.
But that's the Cliff Young story right there,
That
where
is
you
the
want to
Cliff
go
Young story.
forward but not go back, and not have loss to have to make up.
Yes, let me explain. When you're 15 over, you're in the present, whether you want to hear it or not. I am sorry, right?
And by the way, you are in the preservation mode as well.
Oh, definitely.
Yeah, so am I.
So, I hate losing money. You hate losing money, right?
Big
If there's a
time.
way to grow money without losing it, I don't care what age I am. I'm going to do it.
That's true.
But look, if you're 15 over, whether you think it or not, you're in the preservation mode. And what does that mean? It doesn't mean you don't want to grow your money. Of course you want to grow your money.
Yeah.
You don't want to stop growing your money, but you got to avoid the big mistakes. One mistake will screw you up.
Yeah.
You don't want to fall back down the mountain, right?
Yeah.
So the idea is to keep going without going backwards. Because if you
Absolutely.
go backwards, you'll spend all your time making lost money out.
And I also want to say that even in the distribution time, you still
So-
want to grow money.
right, so
You
the
never
next
don't
phase-
want to grow your money.
Next phase is okay. Now you want to use your money. So
Yeah.
distribution is I'm setting it up for income. Some money I'm going to leave to family, but some money I'm going to use for income, how to make it last a lifetime. I guarantee you right now, the financial strategies you use in the accumulation stage, if you try to do them in the preservation and distribution stage, you will eventually have a critical time where it will be catastrophic and you'll scratch your head and be like, oh, I can't believe I made this mistake.
Yeah.
That's what happened to these people I told you the story about.
Yeah.
Look, he was in the preservation stage in life, gambling his money in a casino, And things were going well until one mistake and it did.
So the important thing here also is to know that someone is watching your money, right?
Yes,
Because
who's watching your money?
who's watching your
But we're
money?
going to go over that in the next
okay.
part.
All right, I'm jumping ahead.
So it's income versus income. When we're doing income planning, right? So many people go to a broker who has no business doing income planning because the broker's just trading stocks, right? And there's a rule in financial planning. Well, if you take out 4% of your account and you're in a 60-40 portfolio that's diversified, and you take 4% out, and the market cooperates, and things go well, and you don't do this, and you don't do that.
That's an interesting
and
voice.
if this, maybe
I've never
just
heard that voice.
just maybe, your money will last a lifetime. Is that good enough?
Yeah.
That's
well,
what we
that's
call
horrible.
That's what we call IFCOM.
Yeah. No.
IFCOM is based on a lot of ifs to give you income. And so they use this 4% rule. Oh, you got $1 million. You can take 40 grand out. And there's a reasonable chance you might last a lifetime with your money unless these things happen.
See, that's a man-made.
Then they found out they made a mistake. Why? Because it was made up.
It's man-made. It's just somebody said it.
It's made up on past history, not futures, right?
Yeah.
So they say, oh, now it's 3.3. They don't know. And that's the problem.
Yeah.
I like I'll give you an example. If you're on a plane heading to Hawaii, right, and you're sitting on the runway, and the captain gets on, you may like this voice. Attention, ladies and gentlemen.
Actually, I do like that voice. It's fun.
This is the captain here,
Yeah.
and we're going to have a 12-hour flight to Hawaii. It's going to be somewhat of a smooth flight. We'll serve food and everything. But by the way, there's an 80% chance we'll make it to Hawaii. Would you take the flight?
No, I mean, no.
If it was 90%, we wouldn't even take.
No.
If it was 95, I don't think we'd take.
No, I want to know I'm going to get there.
Maybe 99.9, I'd take that.
That's
flight,
the
right?
IFCOM. You're not
That's
sure.
The IFCOM. You're not sure.
Yeah.
I hate that planning, guys.
Yeah.
Look, for your money, you need for income.
Certainty.
You need certainty, right? That's for the money you want to use for income. That's remember I said.
This is the foundation we're talking about. You know it's coming. You know it's coming.
Key requirements for rock solid income, it's got to be predictable. You got to know it's coming in month by month.
Yeah.
It's got to be sustainable, right? Predictable is month to month it's coming in or every quarter.
However you take it.
Sustainable is going to make sure you last it for the rest of your life, and it has to have some topic or discussion about how you could take out more over time to have it increasing.
Yeah.
Makes sense?
Because of
if
inflation.
you want a rock solid income plan, then you need to set up that appointment with us. You need to click on that with complimentary consultation.
Yeah.
You need to click on it now. But in the meantime, this is time for our fourth poll. We got 5 polls total.
We're almost done.
We're almost done here.
Yep.
But let me put up the polls.
Yep.
It's a pretty neat set we have, honey. I like it.
Well,
I think we should make this office a studio.
Okay.
Current income plan.
Crazy. All right, let's take this. Let's do this.
Our team is at home probably laughing at us now. I know these people are crazy.
So rate yourself on your current plan for income. Now, Social Security is part of that. So, but it's not the whole
here's what I
thing.
want to rate it. Like, if you're retired or you're not retired, right? We'll talk about your retirement income.
Right.
So if you're retired right now, you got pensions, Social Security, you got more income than you could spend. You're at 10.
Yeah, you got
you,
this. Yeah.
But if you're like, okay, you're not retired yet, you're kind of wondering what income you should have, or you haven't even addressed it. Like if you haven't even talked about a plan for it, you're a 1 or a 2, right?
That's true.
But like, again, so we're definitely seeing a little different in this poll, right?
Yeah.
But again,
not surprising.
Not surprising.
We have
some people are 7 and 8.
Yeah.
Some people, congratulations, 9 or 10 on this one. Look, again, depends where you are in life. This isn't written in stone. Just pick which one you like the best. But I'm going to go with
looks like 5 or 6.
Yeah, I'm going to go with a 6 on this one.
Yeah, it looks like some people need some tweaking. Then we got some people who are pretty good at it, which is
if
great.
you're a 6, congratulations.
Yeah, that's
great.
good.
If you're a 5 or 6, you're almost there. We just need a little tweaking, right?
Little tweak.
So congratulations. That's awesome. I'm really proud of you guys, right?
Yeah.
So the last one's investment risk, and I will tell you, income and investment risk go hand in hand. When I put these slides together, it's so hard to figure out which one to put in income, which we put in investment, because they really do go hand in hand.
They blur.
But what I want to tell you is, look, if you've got your money in the stock market right now, and there's no plan, like you just kind of, so you said something the other day to me, and I kind of wrote this down, like, if you're hoping the market will go up and you're praying it won't go down, right? You said hope and prayer.
Yeah, I mean,
if your plan is I'm hoping the market goes up and I'm praying it doesn't go down, guys, it's not a strategy.
Hope is great. We all need it,
Yeah.
but it's not a strategy.
Yeah, exactly.
And
Yeah.
you know, you need something a little bit more concrete than just hope. Although hope is good, don't get me wrong.
Before people come to us, what we find when we ask them is they're on the emotional roller coaster of the market.
Well, I think right now we're on that downside.
Yeah. So if you look at this emotional roller coaster, the market is a roller coaster in the dark. You can't see what's coming.
Yeah.
So, you know, when it's going up, people are thrilled, you know.
Euphoria.
It's not buy low, sell at the top, right? It's buy low, sell high. But people look to see the top, right? So they're like, oh my God, this is great. And then it starts going down. And what sets in? First the thing, anxiety. Mm-hmm. And we're getting a lot of calls in our office right now about that. And I really think right now it's an anxiety phase.
You think so?
Yeah,
I do think there are some people headed into panic. Not our clients.
Not yet. Well.
I had the guy that called yesterday who called for Ameriprise. He's like, I want to talk to my guys. My money is flying out the window. He was panicking. Yeah. So I'm just saying.
So let's talk about that a little bit because is it time to panic, right?
Well, I don't think anyone
So look,
panic.
You know, it's not buy low, sell at the tippy top. It's buy low, sell high. I am not here. We are not here to scare anybody about anything. No. But look, Tony Robbins, right? We've done a lot of work with Tony Robbins, a lot of work with Grant Cardone, and like Tony always says, look at it as it is, not worse than it is,
right?
Not better than it is. Look at it as it is. Mm-hmm. So really looking at the market as it is. If you go back a year, it doesn't look so good. It's down.
You mean your account looks down?
Like if you look at the S&P 500
from a year ago.
Yes. I don't know about their accounts. I just know the S&P 500. The S&P 500 a year ago is down.
Yeah.
No doubt about it.
Yeah.
If you're in the S&P, you have lost money, and probably your accounts have lost money.
Yeah.
In the 6 months, it's lost money, right?
Yeah.
But if you look over 2 years, the S&P, I'm just talking about the index, the S&P index. That's the barometer that everything's measured on.
Yeah.
The S&P index is actually up a little bit.
Right.
So 2 years ago from today, it's actually up. If you look 5 years ago, it's up, right? So if you look in the last year, it's definitely down.
Right.
So why?
That's what you mean. Look at it as it is.
As it is, right? If it's buy low, sell high, now may be the best time to take some money off the table before we get into denial and fear and desperation and panic. Now, here's the reality. I'm going to go over this thing called risk. We're going to go over this thing called risk tolerance. And risk tolerance will tell you if you're in panic mode or anxiety mode, because if your risk tolerance is 10%, and you start losing it because your account's down 10%, then you're in panic mode.
Yeah.
Why? Because the broker who you met didn't do a good enough job understanding your risk tolerance, you know, or when you answered the questions, you weren't honest.
Or even more, maybe you haven't visited your account in a while and your life is a little different. I mean,
maybe nobody ever did a risk tolerance for you.
Like we get our teeth cleaned every year, you know, but some people don't look into their
account.
So
look, it's all about risk tolerance, whether you're anxiety or panic, but none of that's good. We want to fix it.
Yeah.
So risk is so subjective. I'm going to tell you this right now. Most people go to the brokers, and the brokers use this conversation of, are you aggressive investor, moderate aggressor, or conservative, or a combination of any of those, right? And so you hear, I'm moderately conservative, I'm moderately aggressive, I'm, you know. And here's the thing: this is this is too speculative.
Yeah.
Right.
It's subjective.
It's so subjective.
Yeah.
Here's what happens: 2008. People go to the broker, invest money in 2006. They go, I'm conservative.
Yeah.
I don't want to like a lot of risk. They put the money with the broker. 2008 comes, they're down 25%. You got $1 million, you lost $250,000, right? You go to the broker, you go, Joe, let's call him Joe the broker, right?
Yeah, or Josephine.
Josephine the broker. So you go to the broker, right? And you go, I lost $250,000. I told you I was conservative, right? And the broker's answer is, and if a broker says this to you, you need to run away from it.
Yeah.
This is not the right way to tell somebody this, but, well, the S&P is down 53% and you only lost 20 to 25%. That is conservative.
That's like if you go to the doctor because you cut off your finger,
right.
And you say to the doctor, this is terrible, I cut my finger. Wow, but you didn't cut your arm off. Like, that sounds terrible. Yeah. It's like, that's not what you want to hear.
The industry is old. The industry is still using rotary phones to call people, not updated cell phones. You know what I mean? It's like time for a change, people.
Yeah,
right? So we actually have an award-winning software. We could actually measure risk on a numerical basis. So 0 is no risk, 100 is the most aggressive risk, and every one of you has a risk score. And it's important to know, this is only one part of it, right?
Yeah.
But it's important to know what your risk score actually is, so you know the level of risk you're willing to take, and you know the level of risk you're willing to handle. That way, if you lose 10%, but your risk tolerance is a loss of 20%, you can handle, right?
Yeah.
You're in anxiety mode, but not panic mode.
Right.
But if your risk tolerance is 10%, you're in panic mode. You follow me?
Right.
So that's the difference.
It has to be aligned.
You know.
Yeah.
Now, with that said, it's, you know, we can actually do an assessment and find out your risk score. And the question is look, knowing your risk score is useless without knowing the risk you're taking. Do you know what I mean?
Yeah, you have to dig into the account and find out that.
Imagine your risk score is 23.
Yeah.
Meaning 0 to 100.
Your personal, like
your personal.
I think I'm like a 21. Like
Yeah,
I've taken it, and I know I'm 21.
So let's say your personal risk score is 0 is no risk, 100 is most aggressive risk. Let's say you're 23.
Yeah.
And you find after we do an analysis of your portfolio, it's 73 in your portfolio. There's a problem there. We need to fix it. So the risk score is useless unless we can measure how much risk you have. Right?
This is a really great tool to gauge where you currently are, what could potentially happen, and why this is important to align how you're comfortable with the account, so that when things like what's going on happen, you don't have the panic set in.
Right.
And
so it's important to know how much risk you have.
That's right.
And then how much risk you want, and then we can make tweaks to your portfolio.
Yeah.
Now, managing risk, how much risk do you really want?
Yeah.
We can customize a portfolio based on your risk level.
Yeah.
Let me explain. You see 3 buckets there. I'm going to go over these buckets pretty quickly, right? So the blue bucket's cash in the bank, money in the bank. You're not going to grow it, but it is safe, right? The green bucket is something that we do all the time, and we call it the green line. If you're a client, you have them, right? This is the one that people don't know about the most. Mm-hmm. It's kind of, you don't know what you don't know. The brokers don't tell you about this one. Check this out. This is an account, and I'm going to come back to this, right? This is an account.
Yeah.
When the market goes up or an index goes up, you actually participate in the upside. But when it goes down, you stay where you are. You don't lose a penny of your money. That's what we call safe and secure assets that are averaging typically around 5 to 8% average rate of return without that risk of the market. Mm-hmm. And then you've got your money in the red bucket or the red line, and that's the stock market. That is a combination of stocks and bonds. Mm-hmm. Now, it could be a very high risk red account. Mm-hmm. It could be a low risk red account, but it is risk, meaning you can lose it, right? So what we want to do, a lot of times we find that a lot of people, I'm gonna put in my little, I didn't try this yet today, honey.
Okay, you gonna write on it?
I'm gonna try. We find a lot of people, 100% of their money is here, and they think they're diversified. I'm gonna go over this in a second. They have the illusion of diversification. Mm-hmm. But we find all the money's there, and we need to actually diversify in different buckets, not necessarily between stocks and mutual funds. Because, you know, let me ask you, if you go investing, right? I'm gonna erase this.
Yep.
And I'm gonna make us big. And if you, what happened here? Oh, I gotta turn this off. All right. Why would someone go, if they're investing in the market, and buy 20 different stocks or mutual funds instead of one?
Well, they would like to be diversified. Right.
So if you find 20 mutual funds all going up and down at the same time, it's the illusion of diversification.
Yeah, you think you
are, but you're really not.
You're all in risk.
And we find that so much, right? So it's important. We can make some tweaks. We can use some things here. But what I could tell you is the one that's missing for most people's portfolio, besides doing a better job on the red bucket, we can improve the red bucket. We've got some great money managers, but the one that most people are missing is the green. Mm-hmm. And if you look here, the green versus the red. Both are good to have. I'm not saying I have one or the other.
Right.
But I'm saying maybe you want a combination of two. Because the red's a roller coaster ride. Yeah. Right? But the green, market goes up, you get gains. Market goes down. Look what happened here in 2008.
Yeah, and,
right?
And that's all about the foundation right there.
Look, and this is what when we talk about a strong foundation, this is what we're talking about.
That's what it is.
Imagine 2008, you stayed where you were.
Yeah.
Instead of going down 50%.
Yeah, it's big.
Right.
And now things are, going down.
So right now things are going down.
So we have getting calls from clients saying, I am so happy that I am in the green line, our terminology, the green line, because I know that my funds are protected right now. Right. And they are not losing sleep, at least on that money, they're not losing sleep.
This is true diversification.
Yeah.
Imagine if you had a green and red line and the market goes up. You're making money in both, not a problem.
Yeah.
But when the market goes down, you're losing money in red, but you're making money in the green.
Yeah.
And this chart went to 2020 on that red line.
Oh, yeah.
So obviously we continue this chart.
All
I'm doing here is a concept.
Yeah, and they're not comparable. They serve different purposes.
Yes,
you know what I mean? You don't
right.
compare the green line to the red. Well, the red line's through that.
No.
The reason for having them is completely different.
Yep.
Yeah.
So let's do this. If you want to learn more about the green line, well, we're ready for the poll.
Okay.
And the last poll is investment risk. So let me put up the poll. And my question is to you, as we do this poll, honey, let me look for it. You could.
There you go. Reset it.
You want to say something?
There you go. Well, no, I mean, this is important. This is probably one of the most important things in the whole entire webinar today is knowing and understanding how you're handling your risk right now. And so this is why we're doing this.
So,
you gotta rate yourself.
The voting polls are open.
Yeah.
Look, I saved this one for last because this is the most important.
That's what I mean. This is the most important thing.
Here's what I found. And this was a shame. Back in 2008, when I was working with people, and they bought a long-term care policy to cover future issues, maybe when they need nursing home or home care, right? But they lost half their money in the market. And I said, this just doesn't make sense. Like going on vacation, locking your door, leaving your windows open, right?
Yeah, like your long-term care is protecting you from loss of that, but there's other
guys, this is where it starts.
Yeah.
This is the foundation. This is where it starts. You need to understand your risk.
Yeah. Oh, good. This is exciting. Go back to the results. I want to see what.
I'm going to hold you to.
Okay.
So look.
Not surprising.
We got a lot of clients on here who have a green line, so
hopefully
they're answering a little higher. I definitely think this is skewed a little here. But most people are answering like 5 to 6.
Yeah, again, 5 to 6.
Need some tweaking. That's good. Congratulations. There are a bunch of 3 to 4.
A couple of 1 to 2s.
Couple 1 to 2.
Okay.
No
judgment zone. We don't know who it
no.
is. Yeah, we just see numbers. We don't see.
What I'm going to tell you is this is the most important one. You got to get this one down before you do anything.
Especially now with what's going on, because you deserve to get this done. Because it's true, right? We often take care of everybody else, but this is an important thing to take care of because it produces panic and anxiety, and
without making sure your money's going to be there, nothing else works. I'm sorry, it takes money to
almost
everything.
Yeah.
So this is so important. Now, I'm going to tell you something. We have a very special surprise for everybody right now. Thank you for tuning in. We're almost done. But here's what I'm going to say. Up until now, I have offered what we call this complimentary consultation, but it's also a complimentary risk assessment. Look, I don't know where you need help, but what I do know is that the risk assessment is usually the first place we start.
It's eye-opening. And I mean, I knew I was conservative, but then when I put a number on it, now I can tell everybody I'm 21.
There you go. Now, if you go, I'm going to put up a different sheet here. Now, we'll get it. Look, if you filled out the other sheet before,
no worries.
That's okay. We'll be able to talk about it. But if you have not yet taken advantage of setting an appointment, you want to do it now. Because we're going to offer you a second opinion on your investments.
Oh yeah, that's good because you're going to show everybody what they're going to get.
So, by the way, you can't get a second opinion from the person who gave you the first opinion. It doesn't work. You go to your broker for an opinion, he's not going to change, right?
He probably won't say, or she probably won't say, oh, I messed up. I really messed up here, right?
What I find funny all the time, we show people strategies and they go, I got to speak to my broker. Not in a million years will your broker ever tell you that what I show you is the right thing, because that means you're leaving them. Why would they do that? Think about that.
Yeah. Well, unless they're retiring themselves, and they say, "Go with Michael." He's a good guy.
Let's be real. Yeah. I'm a guy. I tell it like it is.
Yeah.
Right? Yeah. But you want to click on the 3 dots, the tab, and you want to set this up right now. But let me tell you what this is: a risk assessment. You've never seen anything like this. I put $1,000 value. It's probably worth so much more than $1,000.
It's
Here's
important.
What's going to happen.
Yeah.
We're going to measure your downside strategy. You're going to understand your risk, and then we'll be able to fix it. The first thing is we're going to do a stress test. Now, this is a stress test. We're going to have a written stress test. Now, here's what it's going to measure.
I'm looking at it. Yeah, no worries.
So this stress, you ever go to a doctor, right? You ever go to a doctor and basically do a stress test. They put a bunch of things on you. They put you on a treadmill.
Yeah.
They run you to death.
They run you ragged.
Right? And then they get off and they measure it. But we're going to do a stress test in your portfolio. We're going to see based on 2001, 2008, inflate. We're going to see how your portfolio reacts to different stress tests. This is eye-opening. Just this alone is eye-opening. If you haven't done it, you need to do it. Now, it requires you send us a statement, because without it, I can't do nothing.
Yeah,
right?
we have to see.
But the second thing we're going to do is this. We're going to do a risk-reward report.
Mm-hmm.
Now, most people have a bunch of different funds in mutual funds or stocks in their portfolio.
Of course, yeah.
Do you know which ones you're getting the best bang for the buck? So using S&P 500 as a barometer, are you taking more risk or less risk than the S&P 500? And are you getting more returns or less returns in the S&P 500?
Mm.
A lot of times we find half of someone's portfolio is actually taking more risk in the S&P 500, but getting less returns. That's a big no-no.
Yeah.
Right? So that's going to cover that too.
Mm.
Now, the other thing we're going to do is what we call correlation metrics. It's a fancy word to say before what I was talking about. Why would someone buy 20 different mutual funds versus one mutual fund, right? To diversify. Well, diversifying means non-correlated assets, assets that are different.
They're doing different things.
They're doing different things.
Serving different
so
purposes.
So when the market's not doing well, the other asset's doing
Exactly.
better to hedge it, right? Correlation means everything the same. Well, if you see all this blue here, all this blue, and this is we're going to do a report on this. We could give it to you, but this is someone's correlation metrics, right? But all this blue means that their accounts, they have 20 different mutual funds, and all that blue and gray means that they're all doing the same thing.
Yeah.
So all they have is a bunch of accounts going up and down together. They're not really non-correlated.
There's nothing counteracting the other thing.
The only color I see here, the what's that, like orange, green?
Yeah, Michael's colorblind.
I'm a little colorblind.
It's orange.
You know what that is? Cash. Sometimes every brokerage account has some cash in it. That would make sense, right? That's non-correlated.
Yeah.
But this is where I'm going to tell you who's watching your money. Remember we talked about
who's watching your money?
Look, who's watching your money?
Yeah.
You know, overnight when markets are doing things, who's watching your money? Do you have a private money manager who's making moves on your behalf?
Yeah.
Or is it just kind of like passive? You go
like my guy yesterday who called me and told me he was calling Ameriprise, his money is flying out the window. If he didn't call, and I hope he got through, because he probably didn't.
Probably did not.
And he's
got frustrated, hung up, lost a little more.
Which I don't blame him.
And the last part of this is a written plan. What do I mean by written plan? Well, it's called a portfolio observation report. And what's going to happen is we're going to actually have a written plan of opportunities for improvement. In this case, there were 7 opportunities for improvement.
Nice.
Everybody's different, but we're going to have actually a written
plan. So you're going to get a report
for that, as well as a written plan for your risk tolerance, right? And what your portfolio's risk is. So this is something incredible. We've really never offered it to this level before to anybody.
Yeah. But it's Saturday and we wanted to offer it, and it's 100 degrees apparently.
So if you haven't taken advantage of this yet, you need to.
Yeah.
You need to click on it. This is your last chance, all right? After this, we're just about done here, right?
Yeah.
We'll appreciate your time, but take advantage of that risk assessment. So remember, a goal without a plan is just a wish.
Mm.
You can't hope the market's going to go up and pray that it won't go down. It's not going to work.
Not a strategy.
I'll tell you right now, not a strategy, right?
It's not a strategy.
So with that said, any last words, my honey?
No, I just thank you all for joining us today. It is, as you can tell, Michael and I are really passionate. We actually talk a lot about this stuff off camera, behind the scenes. This is our life. This is our breath. We're really passionate about the industry. We want to help as many people as we can, spread the word and share what we know, our personal experience with as many people, so that you guys have a really fulfilling life and can, see the things that you wish for yourself and your family, just like us. Yep. So if you're not a client, we'd love to have you as a client. And if you are a client, we thank you so much for being loyal. We do have the most wonderful clients in the whole wide world. And as well as team, we also have the best team, and we're growing and we're adding amazing team people as we speak.
Right. So whether it's a 7702 plan,
we went through a lot.
Need to talk about better fixed rate options for your money in the bank.
Lazy money.
We need to talk about the green line to protect your money and grow it, which is phenomenal. Or we need to start with doing a risk assessment. We can meet you where you are. Yep. Typically, it'll be first a phone call, like a 15-minute phone call to understand your situation and tell you what we need from you in order for us to continue, right? And we can do it virtually as far as the meeting.
We're
can do it here in Shelton.
We do it virtual.
But it'll start, this complimentary risk assessment or the complimentary consultation. It's all the same, right? Mm-hmm. But like we start with a 15-minute phone call just to explore what your needs are, what you're looking for,
Yep.
to tell you whether we can help you.
So
Look, your time is valuable, our time is valuable.
Yeah.
We want to make sure we can help you and make sure it's suitable, and that's why we start here.
So our teams, if you fill out a form, we're going to reach out to you on Monday. So enjoy the rest of the weekend. Do something beautiful. Do something fun. Stay cool. And on Monday, we'll reach out and call, and we'll set something up, get you on the calendar, and hopefully I feel very good that we'll probably be able to help you out. So I think we're good.
We're good. Have a
Thank
great
you, everyone.
Saturday. Have a great
Enjoy
Sunday.
the rest
Thank
of
you
the
so
day.
much for coming.
It's been
Take
great.
care, everybody. I'm going to leave you with our little
You can play our video.
video.
Rock it
from
out, baby. Rock it out. Rock your retirement.